Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today, we're looking at a final concept as it relates to bad debts, and that is to prepare ledger entries. The objective at the end of this lesson, you should be able to demonstrate how to write off bad debts using ledger accounts. So in exam, you may be asked to write off the bad debt using ledger accounts. So they'll ask you to use the ledger accounts to show the entries to write off the bad debt. But before we go into an example, you need to recall the accounting entries. And these are upon declaration, the bad debt account should be debited while your customer, which is your debtor, which is your trade receivable account, should be credited. At the end of the accounting period, you debit your profit and loss account. So don't forget to list the bad debt as an expense because this is a cost incurred by the business. The business is now absorbing that cost. Hence, it is an expense, and you credit your bad debts account. So let's take a look at the example. Jaylee sold $50,000 good to Shade on March 20th. She was declared bankrupt on July 23rd, 2020, and you are required to prepare the ledger accounts. Before you actually write off the bad debts, you have to show what is the amount or what is the entry that was in Shade's account before the time of the declaration of bankruptcy. And this comes from the first line of the transaction, the example, where the $50,000 goods were sold to Shade. In that case, the two accounts affected are your sales account and the customer account, which is Shade. Shade did not pay. Hence, there is an increase in debtor, which is an asset, so you debit, and your sales account will be credited. But we're focusing on the debtor. So we're preparing the account for Shade, and this account should be debited. So we're making a debit entry, and this is March 20th, because that's the date on which you sold the goods on credit. The other item affected is sales, so that is our details. And the value of goods sold to her is $50,000. The other aspect of the example, she was declared bankrupt. And when was this? July 23rd, 2020. We're showing the writing off of the bad debt. And in write off the bad debt, we need to relieve the debtor of the amount that is owing. So therefore, we are going to credit. This took place on July 23rd, and our details, which is the other item affected, is bad debts. And the value that we're writing off, that's the value that she's owing, and that is $50,000. So when you write off the value that the person is owing, then there would not be any balance in the account. If you look on your debit side, you're seeing $50,000 in total. On your credit, $50,000 in total. There should not be any balance once you have written off the debtor account. There should not be any balance in the account. So we have our credit entry. We're now going to make our debit entry, and that is in our bad debts account. And our bad debts account should be debited, and that is July 23rd. The details, which is the customer account that you're writing off, is Shade, and the amount is $50,000. We're going to take a look at another example before we do the end of period recording. And for this example, it states on August 19, 2020, Jaylee sold $35,000 goods to Shay. So now we have a new customer. She paid $17,000 cash on September 2nd, 2020. Another payment was made of $10,000. This was by check on October 25th, 2020. You are required to prepare the ledger account because it became obvious that Shay would never be able to pay the outstanding balance, and Jaylee decided to write it off as bad debt. But before we write off Shay's account for the bad debt, we have to show the entry that took place on August 19, where goods were sold to her, $35,000. So let's create an account for Shay. That is Shay account. And we need to show the August 19th entry. Goods were sold to her on credit. This is an increase in the debtor. So debtor account is debited. That's August 19th. And the details is sales, which is the other item affected. And the value of the goods purchased, of the value of the goods sold to her on credit is $35,000. So she purchased $35,000 goods from the business on credit. Other information provided is that Shay made a payment of $17,000 by cash on September 2nd, 2020. We need to show that she made a payment. Now, once a debtor make a payment, that will be a credit entry. And in this case, our cash book would be debited. The date on which this payment was made is September 2nd. And the details, which is the other item affected, is cash. That is the method that she used to make her payment. And the value that was paid on that date is $17,000. We were also provided with another payment detail, and that's $10,000 was paid by check on October 25th, 2020. So we have to show that again, she's reducing the value that she's owing. She's a debtor. Debtor is an asset. So you're going to credit. The date is October 25th, and the details, it's check. So therefore, we know that that is our bank account that is affected, and the value there is $10,000. So we're seeing where sales of 35 was made on credit out to Shay on August 19th. Shay paid $17,000. She also paid $10,000 out of that 35,000. So we're seeing where she's owing to the business based on the balance in the account. Thus far, she's owing $8,000. It became obvious that Shay would never be able to pay the outstanding balance. What is the amount that is owing by her? Remember, $35,000 worth of goods sold. She paid $27,000 in total, so therefore she's owing $8,000. Jaylee decided to write off that $8,000 as bad debt. So in the debtor account, remember, the no date was given, so we're using the end of the accounting period, and that is December 31st. The other item affected, because we're writing this off as bad debt, or details is bad debt, and the amount that we're writing off is the value of which she's owing, which is $8,000. Now, if you should check on the left-hand side, you're seeing 35,000. So the total for that side is 35,000. And the total on the credit side is $35,000. So we're seeing where after the writing off of the bad debt, there is no balance in the account for Shay. Now we have our credit entry. We need to show the entry in the bad debt account that we made. And that is the same date, December 31st, end of the accounting period, because no specific date was given. Our details is the customer's account that we're writing off as bad, which is Shay, and the value that she was owing, $8,000. That is written off as bad. We know, after having looked at those two examples, we're now at the end of the accounting period. So therefore, we need to show the end of period adjustment. And that is to send the value from the bad debt account to our profit and loss account. In that case, our bad debt account would be credited because we're sending out the difference, the balance that is in the account to our profit and loss account. So therefore, it's December 31st. Our details would be profit and loss, and the value that is in the account, which is 58,000. So the 50,000 plus the 8,000 give us 58,000. Our totals after doing that would be the same on both sides. So our totals would be the same on both sides. And we are basically sending out all that balance that is in the account to our profit and loss account. So we're going to prepare the profit and loss account, and the amount that we're sending to the profit and loss is the actual value of debt that were written off for the period, which is 58,000. So let's look at our profit and loss account. We're preparing that account for Jaylee, and it is profit and loss. It is an extract because we're not doing the full thing. It is not as that, but for the year ended 31st of December 2020. And bad debt, when you're debiting the profit and loss account, you're listing the item as an expense. Bad debt is an expense, so we're entering that category less expenses. Less expenses, and the expense that we're entering is bad debts. We're showing how we actually treat the bad debt in the profit and loss account. And the value, the total value of bad debt for the period is $58,000. And we have completed those two examples. And at this point in time, I'm pretty sure that you are now able to do the ledger entries to write off bad debt. So remember, the customer account is credited and the bad debt account is debited once it is clear that the debtor is unable to pay. At the end of the accounting period, you are to debit your profit and loss account, showing this bad debt, the total bad debt for the period, as an expense, and you would credit the bad debt account because you're transferring all that value that is in your bad debt account, which is on the debit side, to the profit and loss account. So we can safely say that we have achieved the objective where you're to demonstrate how to write off bad debts using ledger accounts.
Like, share, and don't forget to subscribe.